And I think we want us, first of all, to start with the CBN auction of dollars today. And we're seeing significant pressure on the Naira recently. It's down to 158 to the dollar. So your thoughts on the fact that we're now seeing the central bank selling $200 million, much higher than what we've seen recently?
Yeah, hello, Wole. In the last couple of weeks, the interbank market has been, there has been high demand for liquidity in the FX market. This is basically due to the fact that counterparties took positions expecting the NNPC to sell funds to the market. However, this did not happen as the funds were sold to the central bank. Counterparties had to scramble around markets trying to cover their various positions, and this has been pushing the rates up in the interbank market. Before now, the WDAS window and the interbank window has been converging, and demand has actually been low. But because of these sales to the central bank as against to banks in the market, rates are demand has increased again. Okay. Currently, the interbank, and since last week Monday, new highs have been made as people have been trying to get funds to cover their positions. Interbank market closed today at 157.75. While the WDAS market, 200 million was sold at 155.75. That's effective 157.31. So the gap is widening as we go.
Right. Your thoughts on the widening of that gap? Do you think we're going to see the interbank rates come down a little bit after the central bank came to the table with $200 million today?
Yes. I believe the gap is going to reduce with time, because as of earlier today, the market actually traded as high as 158.08, but closing today, the market closed at 157.75. Right. This gap has reduced because the CBN has also increased their offer in the market. 200 million was offered today and 200 million was sold. In the previous weeks, we've had the CBN offering as low as 50 million. However, they have increased their volume, so we expect to see market easing up.
All right, we've seen some tightness in the interbank money market recently, and can you just speak to the reasons for that and what can we anticipate with the monthly allocations expected to be disbursed sometime this week, I believe?
Okay, the interbank Naira market has been liquid for a while now, and overnight NIBOR has always traded between 10.25% to 12%, except for today when market actually traded for 10% as a result of the great reduction in system liquidity. Market opened today with 20.23 billion. This is due to the fact that 148 billion left the system on Friday for almost sales by the CBN in a bid to mop up liquidity. 101.6 billion matured on Friday, and the CBN tried to mop up the day after. That was on Friday. Also, for the federal allocation, the committee met last week and 574.0 billion was approved. However, we expect about 275 billion to come into the system today. Once this is received into the system, we expect to see rates dropping again to about 10.25%, which has become the norm once these inflows come in. Okay.
Well, clearly, those are some of the factors that the Monetary Policy Committee will be discussing about now as they go into the second day of their discussion. And of course, we'll see the MPC decision at some point tomorrow. But give me your thoughts on how the interbank market reacts to the MPC and the build-up to the MPC. I mean, do we see any tightness, or do we see any reaction ahead of those decisions generally in the money market? We know we see some in the bond market from time to time, but what about the money market?
Well, for the money market, counterparties generally take positions against MPC decisions. In periods when we expect the MPC to increase rates, counterparties, that's the placers, generally want to place short, while the takers want to take in tenured funds to lock in yields. This is to avoid having to pay the high cost once the rates go up. On the other hand, in the periods where we expect that rates will go down, you see the takers trying to take tenured funds to lock in, so that when the results actually come in and rates go up, they would have locked in and they'll be enjoying the benefits. So basically, people just try to play either in the long or short end of the curve, depending on the side they are on.
How did they play today in your books, and how people trade ahead of that MPC decision tomorrow, in your thoughts?
Okay, today, considering the market has been liquid, because there has been liquidity, and in fact, we still expect to see liquidity in the market, And due to this, we really don't expect any major change in the MPC decisions. At worst, what we expect to see is marginal increases in probably the cash reserve requirement or the monetary policy rate. We expect very marginal changes, increases, if at all. Since most counterparties were from the school of thought that the MPC will maintain status quo, people just traded normal in the market. There were no major differences in activities.
Okay, so I think that more or less reflects what I'm hearing from most analysts, the fact that the MPC is likely to keep that rate decision unchanged. But what about inflation? Is that having any bearing at all? That number was higher today at 11.7%. Your thoughts on how that is impacting on the money market?
The inflation is not having any impact on money market. What affects the market is majorly liquidity in the system. And rates went up today because of the low liquidity. However, the consumer price index was released today and the rate went up to 11.7%. That's from previous months, that's September's 11.3%. This basically, I believe, is due to the hike in food prices, due to the flooding in the food basket of the nation. That's the middle belt. And food is one of the major components in computing inflation. Also, the core index decrease has been on the decline. It actually dropped to 12.4%. That's from 13.1% in September. This rate has actually been on the decline. The highest we've seen this year for core inflation was 15.2%, which was in June. And this has been on the decline, I believe, is due to the monetary policies put in place by the central bank to curb any increase.